dealer's inventory level, it went above it, went below it, went above it, went below it. If you bought and sold the RGL, you actually would have still have been able to make even money on pretty much every single one of your trades, and a lot more. So if you did do it as a structural trade, you actually still made money. I think as a structural trade, there was effectively 1 or 2 losers maximum. 1 or 2 losers. And as a structural trade, we had 1 big winner, 2 big winners, 3 big winners, 4 big winners. So you had like 2 losers and 4 big winners and 2 plus ones, 2 plus ones. So even if you took the you might be looking at dealer's inventory and say, damn it, I traded that dealer's inventory and I lost money. You couldn't have lost money in the dealer's inventory today, guys. It was almost impossible. So the first dealer inventory trade we had just as a basic structure was a buy trade here, right? And it went straight up for a very substantial profit. It dropped back down and it broke back up again, so you'd have been able to buy again into that same price. Now that's the one you lost money on because it then broke south and it lost you the full 2% if you're using 2%. But if you sold there, it never went back above, so you never lost any money on that sell. You actually made a substantial sell side profit. Way more than 2%. Just like you made way more than 2% on this trade, right? So if you're using this as an idea, this one made about 2, 4, perhaps about 5%. If we're being realistic, this made about 5% maximum swing, okay? So let's just see what, if you took every single dealer inventory trade for a maximum swing minus a full loss, and then we took this buy trade here, you lost 2%, right? So you lost 2% on that trade. And then if you sold this one, you probably made what, about 2, 4, again, maybe about 6% on that trade, right? 6%, reasonable. That's maximum swings. So perhaps 2 plus 6. If you're doing 1%, 1 plus 6, 1 plus 3, whatever. And then the next losing trade was this one here. It broke higher, didn't give you an even money trade, stopped you out for a full loss of 2%. Good stuff, minus 2%. In the meantime, you might have had that trade there which gave you 2% plus a scratch, so we're just dismissing that trade because it was an even money trade. This one didn't quite give you 2% and a scratch, so that's why we're counting it as a minus 2. You see, we're being fair, right? We're not being stupid about this. We know the losses take place, but we're trying to give you the idea that you would have been able to get a full 2% there, but this one made you even money and scratched you. Then it broke south, and you made about 4% when it broke south there, so it's better than an even money trade there. And then it broke north, and you made even money in scratch. So we're not going to count that. It's just an even money in a scratch trade. So you maybe made 1% gain, and then you get stopped out for 1% gain and 1% loss, and then you just said, right, that's it, a 0. That's a 0 trade. And then you sold this one. And exactly the same storyline. You sold this one. And because you sold this one, you've just went from $94.60 to a low price of $93.60, $1,000 sell. Now, $1,000 sale is, in percentage terms, yeah, fair enough. But we're looking around about 8 times your money on that trade. 8 times. Potentially your money on that trade, aren't you? Potentially. Now, obviously, if you're using a little bit bigger or whatever, you're looking at about a 100-point move. So realistically, you're maybe saying, well, what about 6 times your money? Yeah, okay, 6 times your money. 2% risk, 12% gain. Would you have been happy with that percentage? Would you have been happy with those percentages over the course of your dealer inventory trades using a almost algorithmic process to trading? 5%. I know you're not going to get 5% and 6% and 4% and 12% because they're the maximum swings. But you'd have at least have got 2% and 2% and 2% and 2%. So even in a world case, a worst case, worst trader world, you'd still have made 4% during that period. Still made 4%. If you were the world's worst trader, you'd still have made 4%. Now that's pretty good, right? The world's worst trader at trading the outcomes of these trades, you still make 4% gain. That's got to be solid, right? That's got to be something you look at and go, oh, wow, I like that. I like that a lot. But obviously one of the things that we do is we can understand these and try and figure out whether we want to be buying above the dealer's inventory in the first place, right? So we can obviously look at some of the big swingers and see if we can come up with some ideas. So when I see the price going above the dealer's inventory up here, or below the dealer inventory, I've got a lot of tools. I can look at yields. I can obviously look at the main driver of the dollar. I can then look at the crack spread. And I can start answering the question, would I really want to be buying or selling above or below these areas? And I'm going to be able to make better decisions based on that narrative. So we can see, for example, if we just use the dollar, would you have ever have bought any of the buy trades above the dealer inventory, yes or no? Would you have bought any of them based on the dollar? You wouldn't have bought any of them, would you? You would never have bought any of those breaks above the dealer inventory level based on the US dollar's price action. Well, if you're not going to buy the break above, what could you be thinking about as a possibility? Just as an out there possibility, guys, what could you be thinking about? If you're not going to buy the break above, maybe just a possible sell trade? Potentially selling into the break above on a level 2 liquidity that suddenly looks a little bit like this. Sell side dealer inventory at the top edge, sell side top edges here, and it becomes a possible commercial short. Could that be a sell? Could that be a trade? Could you think about that as a possible opportunity? Sure. If you don't like fading the top edge, as Catherine mentioned, if you don't like fading the top edge, what about then just making sure that you're selling the break back below? And then you've got a sell at the top edge and or a sell break back below the bottom edge, and you've just traded it to where? Your measured move, haven't you? You've just traded it to, unbelievably, the measured move, which we already knew about, right there. And you say, thank you very much. My oil trade is done for the day. What happened at the measured move, guys? I wonder what happened at the measured move. What do you think happened at the measured move, Simon, without looking at the charts? Just close your eyes. And whilst your eyes are closed, type in what happened at the measured move. That's going to be fun. Type in what happened at the measured move. Well, it bounced. But what else? Massive volume, Mohammed, right? Massive volume. So why was there massive volume? Well, because it was a measured move. Is that all? No, because I already knew that this price was significant because it was the session overnight lows. Yes? So was it one thing again? Or was it several things? Was it one piece of information about it being an overnight low? Or was it several elements about it being an overnight low? It was the lack of the dollar continuing to be bullish. It was the lack of the dollar being bullish. In other words, when we came into that level there, based on the dollar valuation, what is this level called? If the euro dollar hasn't gone any lower, what does this level get called? Donald? Miguel? Mohammed? Alan? What does the level get called, guys? A guaranteed discount, right? Because if the value doesn't improve, but the price doubles down, it's a guaranteed discount price. That's how we find some amazing opportunities to maybe buy into these guaranteed discount price trade areas. So when the value is not bearish because it's neutral, nobody can tell me that the value is bearish since the last time we were here because it's the same price. It's the same price. It's not bearish. It's not bullish either, by the way. Make sure you understand that, guys. I'm not saying the value is bullish. What I'm saying is the value is neutral. So when the price gets down into a guaranteed discount, it's going to find a lot of profit takers. And there's going to be enough profit takers that the price will probably bounce and give you a very nice profit. Well, the price bounced for about, what, 600 bucks? That's a pretty good profit. Does everybody think the market's actually still bearish, though? Sure. The market certainly still looks bearish on oil. No reason why we shouldn't consider the market still to be a sell-side opportunity on a macro scale, yeah? So when we see that sell side on a macro scale, we start looking for it. We start thinking about the structures. Where could you sell a macro? Where could you sell an oil trade, guys? Could you sell a level 2 spring? Could you sell a halfback? Could you sell a pullback to a key structural break? Yes, yes, and yes, couldn't you? Yes. Did you get all of those in one trade? Well, we got a very, very nice little spring trade here, yes. Structural trade, level 2 liquidity right there. Is that where the sell came in from? Sure. Why was that important? How did you know the sell was going to come in here, Paul? How did you know the sell was going to come in here? How did you know to get involved in that sell right there at that stage? Paul, over to you. Take it away. Or anybody else that has an answer. It was a change of behavior, but specifically not about the price. Specifically not about the level 2. Specifically not about a halfback. Why that trade? Because we're coming into the NYMEX Open. What happens at the NYMEX Open? We get a volatility expansion. And if we're not in it before the volatility expansion, we're not in it. Full stop. End of trade. So what we try and do before the volatility expansion hits is we try and figure out what the deal is going to be, right? And for me, this looks like a very good deal to get in for the volatility expansion at 1400 hours. And sure enough, as if by magic, the volatility expansion comes in just a little bit early. No danger there then. And we simply get this enormous opportunity, then use the big volumes just to book our money. You're getting in before these sellers get in. You're not trading in the shadows of the smart money when you see that type of sell trade. You're actually the smart money, aren't you? You're the informed money. You are the inside traders. You are the guy that's looking at that going, get me some. Take a look at the crack spread in isolation. Remember when I'm talking about taking a sell trade, what I always talk about is a macro sell, micro buy. Yes or no? When I'm just in isolation of using the crack spread. A macro sell and a micro buy. Did I get a macro sell and a micro buy? The micro buy we're talking about, I did ask yes or no and nobody says yes. Simon, thank you for that vote of confidence, but we got a micro buy coming in right there, didn't we? A micro buy, which means we must be looking in the background and say, well, the macro must be a sell against that time frame. So we get a macro sell and a micro buy. Well, now I'm interested in selling. A macro sell, a micro buy, I'm interested in selling. What better place to sell but a level 2 structural break? A level 2 and a structural break 2 minutes before the NYMEX Open. What a beautiful opportunity for me to sell into. And sure enough, down she goes. Do you not realize what the crack spread is, guys? Crack spread is the demand side of the market. Calendar spread is the supply side, yes? The demand side comes from the crack spread. The demand side comes from the supply side comes from the calendars, because that's the input product. People don't buy crude oil and then shove it in their cars. If you did, you're probably going to have a bit of a mess of a car, right? Good luck with that one. So the output is the crack spread. The output is the crack spread. The crack spread is the refiner's profit margins. And if the refiner's profit margins are going down, we know that that's bearish oil, because the refiner's going to be demanding a discount on the next purchase of oil. And that's what's happened here. The oil price at this stage hasn't gone anywhere, to be honest. It's gone sideways. But the crack spread's going down. This is the perfect sell on the oil price. Perfect. I don't need to see any other value lines. I just need to see the value. I just need to see the liquidity. I need to see the value here. I need to see the time of the day. And I need to make sure I am in that bit of business. And I've managed to sell off the 94.30s, and it's now down at 93.30s. I've just made $1,000. Is that not really easy, guys? I don't know, perhaps not. Perhaps not. But I think it is. And I hope after you've done this classroom for long enough, you'll start to agree with me that that's really easy. But even for the experienced traders, they're still making screw-ups. Every day they make screw-ups. But that's how they learn. I occasionally still make, no, I don't actually. But, you know, you get the basic idea that you're not going to just suddenly become the best trader on the planet, because there's a lot of stuff to keep reminding yourself. You have to keep going over it and making it muscle memory so that it becomes just the way you trade. It's not about one occasion, it's about doing it every single day, asking the same questions every single day, rinsing and repeating it every single day, trading the transitions every day, trading the measures every day, drawing in the V shapes and the N shapes. I mean, take a look at that, for example. So we had a high price. So where do I know that I'm going to be targeting, guys? Because I've got a bottom edge, which is there. I've got a high price, which is there. So I know automatically what my target price is, correct? But did you do it? So there's my target price, yes? But did you do it? Did you put that price on your charts? Did you take profits at 41? Did you actually use that piece of information, or did you forget to use that piece of information? Again, it seems like it's supposed to be dead easy to keep doing this, and yet how many out of 132 people in here forgot to do it on their last trade? Would it be reasonable to suggest 115 people forgot to do it in their last trade? Probably not. And that's people that have learned. So here's the main takeaway from any education. It's not the education that's the problem, guys. I'm sorry to tell you. It's not the education. What we're teaching you is the market reality. You can see it for yourself. We've done half-back sells. We've done measured move sells. We've done, and every time we get a half-back and a measured move, you see the volume pours in and the price bounces, as if by some sort of magic. Well, it's not magic. It's just the market truth. It still doesn't mean people will get the right trade in this classroom, because they've still got to do it for themselves. They've still got to see it. They've still got to have confidence in it, and they've got to keep doing it. It's part of the drilling process. So when I get my target price, what do? I take my profits. I buy into that area and I say thank you. It doesn't matter what it is. And how much profit do I take depends upon how much value is evolving at that stage. If the value's flipped, I'll take everything off and I'll start looking for a buy trade at the bottom edge. If the value hasn't flipped, I'll take a small piece of position sizing off, and I'll try and hold the remainder for a continuation move. I'll try and add that small piece back in after a small bounce back to the upside. And because you've done that structure and you're still bearish, you've taken a bit of profit taking, what would be wrong with you saying, well, there's another structural break, spring trade, sell opportunity to go back in again right there? What's wrong with that trade? Nothing, right? It's structurally a perfectly good trade. You could check out your crack spread and ask the same question. Is the macro still bearish? Am I getting a micro bull? Yes. Okay, so I can sell that as well, can I? It's exactly the same as the previous sell. Exactly the same as the previous sell, yes or no? Yes, it is. And we come down into the bottom edge, and suddenly the crack spread is no longer dropping. And you say, okay, crack spread's no longer dropping. Close me out. Back into the volume there. You're closing out their position. Your downside move is finished for the time being. And you finish off your trade at that stage. You just say, thank you. Close off at 93.40s. You've just sold 93.90s. You've made $500 on the second trade. You made nearly $1,000 on the first trade. You've just made $12, $13, $14, nearly $1,500 on a single contract on oil during that period. That's a good session right there. It's a very good session right there, isn't it? It's only very good if you do it. It's not very good if you say yes, 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 yes. I can see it. Okay, but did you do it? No. Okay, so if you can see it but you didn't do it, what's that telling you? If you can see these things but you didn't do these things, what does it tell you? Does it tell you that the education sucks? Or does it tell you that your trading sucks? I think it tells you that your trading is rotten, right? Your narratives are rotten. It tells you that you're not doing this stuff on the right-hand edge in real time. You can see it, but you just don't do it. Well, to me, that's the biggest sin in the world. Knowing what's right and still not acting on it, to me, is the biggest sin in the world. You see an old lady getting mugged, and instead of acting and going and helping, you shirk your responsibility and walk away, walk in the other direction because you might get stabbed. Fuck it! You're there to take action. You've got to get involved. There's too many people walking away from these opportunities. Too many people turning the other shoulder. Too many people saying, I'm not going to get involved. Get involved. You've got to do stuff. It's the way you live. You don't hide away. You take action. It's what trading's about, guys, is taking action. And if you take action, more people will take action. If you take action, more people will take action. Be the leader into that trade. Take the sell. Boom. $500, thank you. Now what's next? That's why when you hear about trading, you think these guys are all, absolutely choked up in testosterone or cocaine or something. Well, it's probably in most cases a mixture of both. Because I was ripe in the early 80s, right through the 90s. It was like a lump, a man's world of aggression and fighting and elbowing. And if you've ever spent any time in the pits, you'll know it's all about elbows and spit. And it's the loudest voice and the most commanding presence that gets the deal, right? The loudest voice, the most commanding presence that gets the deal. Did you hear in the webinar with Charlie D? He was talking about expanding the pit. He's talking about expanding the pit so that he gets the view. And he makes this tiny little squeaky voice sound that he goes, 5-5. And he's making a point there. You want somebody to pay attention. You say, buy 5, and you're in there and you're bawling it out and you're gesturing loud and proud. I want to buy, and I know I'm confident. And the guy says, sold. Yours. Trading's the same, guys. If you're going to get in trade, get bold and get in the trade, for God's sake. Get bold. Take your shot. You'll feel amazing doing it because you're actually taking action because of confidence. And if your confidence is misplaced, you'll learn. If your confidence is starting to get on point, you're getting great prices. You're getting great execution, guys. You got to get bold. Or you just might as well pack up and go home, guys. Pack up and go home. Well, come in, guys. Cash open.